Hey, what's up guys? Tyler here from Fallible, and today I'm going to show you how I made another $5,100 trading the market volatility in August. But this trade's a little bit different. If you guys remember, the last few I've covered are about going long volatility and making money when the market crashed straight down. This one is actually playing the rebound, so it's a little bit of an interesting trade. I definitely want to show you guys. Before I get into it, make sure to head down to the bottom of this video, hit that like button, smash the subscribe button, hit the bell, and leave a comment and let me know exactly what type of content you want to see. All right, now let's get into it. Okay, so here's my trader view again, and I've pulled up the long trade, and this is using ticker SPXL. Now, what SPXL is a levered long equity fund that essentially just tracks the market like SPY or SPX, but it does 3 times the movement. And the reason why I use something like this, 3 times the movement, is I get a little more bang for my buck. You know, I don't have to put up as much capital to make the same amount of money. I can buy less shares. It saves me on commission. So if you guys are wondering, that's why I use a triple lever ETF. Now, I would not recommend people using this if they're unexperienced, and I especially do not recommend people buying and holding with this. Something like SPXL or any 3x levered ETF is only reserved for people that know exactly what they're doing and are taking short-term trades. So as you can see, guys, this trade was on August 5th, 2019, and if we look at the details here, you can see the exact executions. I got in near the end, near the close, which is how I always do this trade. You're guys going to see here in a second how this works. So right at 8:05 at 15:55, 5 minutes before the close on August 5th, I got in, and then I got out the next day at the close. And you can see the little markers here. Let me pull it up. So you can see I entered here and I sold there. Now, let me dig down a little bit into my charts that I use to track this. And so here's SPXL. And remember, this is just a 3x levered ETF. And 3x levered ETFs, they just move 3 times what the underlying indice would move. And again, this is just so I can save money on commissions and buy less shares. As a professional trader, you're always thinking about costs, how you can lower those costs to eat away at your profits. So that's why I'm an SPXL. But it's not because, I'm trying to bet an insane amount of money. Anyway, here is the day in question, August 5th. And if you guys remember, August 5th was that other day where I made a lot of money going long volatility. And this is very common with these trades. When we get something that's very volatile in the market, I'll make money on the way down and on the way back up on the snapback. And that's because volatility breeds a ton of opportunity for traders. Volatility is the lifeblood of traders. And so when we get these type of conditions, they're very easy to exploit. You can make a lot of money very quickly. But if the market's kind of chopping around up here at the top, not really moving that much, I'm not going to be making that much cash, which is why August was a huge month. And now that we're breaking out again in the market, as you can see here, I expect volatility to compress, and it's probably not going to be as good for at least this style of trading that I do. Anyway, I want to show you guys exactly how this works and how I discovered this particular trade. Okay guys, so if you look at the screen here, you can see that it says symbol ES type long, and then there's some parameters right here. Now this is the actual algorithm that I created to find this trade. And what you can see here is that there's a few conditions. We have, it has to be Monday or Tuesday, so Monday or Tuesday equals 1. The rate of change of the close and 3 days ago now is less than the rate of change of the close and 3 days ago, 2 days ago, which essentially just means the market is accelerating downwards. So that's an easy way to say it. And then stochastics 4 is less than 20, which is just another way to say that the market is accelerating down very, very quickly. That's what it means in layman's terms. And if I go back to trading view here, you guys are gonna be able to see a few of these. So here's the ROC indicator, and you can see on August 5th it was an extremely low level, and then same thing with the stochastics indicator, extremely low level. And on top of that, August 5th I believe was a Monday, and let me go check back to confirm that on TradingView. Let's see, August 5th. Yeah, August 5th was a Monday, so all the parameters were met in that particular trade, and it triggered and fired off. And you can see I have this particular algo. It's called BA algo, and if I switch it on real quick, you'll see how it prints a yellow bar after all those parameters are met. So this makes it very, very easy for me to go and find out if a trade's happening. So you can see there's a signal there, signal there, signal there. And I didn't cover these trades on the channel yet, but I'll go back and do that. But this one is the most recent one that happened, and so that's why I took the trade, and you guys saw the results in TradingView. Now, I want to go back to Build Alpha real quick here. Let's pull this up. And then you guys can see how this trade has performed over time. So I click individual equity curve right over here. And then this is essentially how this trade has been performing throughout time over the last 275-ish trades. If I click trade number down here, we actually get dates. So now you can see 2019, 2018, 2013. And you can see this thing's been a consistent performer since 2001. And so this unhighlighted curve right here is what I did a lot of the testing on to figure out this strategy. And then the blue right here is how it performed on future data. So when I went back and I was doing the research on this strategy, I tested on this data set, and then I found out going forward it continued to work. That's the exact type of edge you want to see. You want to see something that worked well in the past and then is continuing to work on new data that the computers never saw or you never saw to eliminate maximum bias. So this is a great trade. And if we pull up, say, the buy and hold curve here, we can also see that, from the 2001 crash, the 08 crash, this recent crash here, and then these crashes, this thing actually crushes it in volatile times. So yes, it's a long only algo, but it actually performs the best when the market gets volatile and we're in a bear market, which is why I like it so much. And this is something you wouldn't really think would work, right? Because if we're in a bear market and the stock market's downtrending, you wouldn't think a long strategy would actually make money, but it turns out that it does, because in bear markets, they tend to be extremely choppy, very up and down movements. And you get these massive rips up after these huge down days that you could capitalize on a lot as a long only trader. And I have a few buddies of mine who were professionally trading back in 2008, and they made an absolute killing going long the market on some of these rip your face off rallies, because yes, the market can crash 5 or 6% in a day, but when this thing comes back, it can also rip roar back in up 5% in a day easily as well. And typically the long side tends to be easier of a ride than the short side, just because of the nature of trading, and that's why I like longs better than shorts. But anyway, let me get back here to TradingView. So anyway, this one triggered on August 5th, 2019. I went into here. You got to hold this one overnight, which is a little bit scary. You can't exactly stop out of it, so you have to size correctly on this one. I'm going to go talk about sizing here in a second. And then I just sold the next day at the close. And this is just a one-day trade, guys. So you're in, you're out the next day. You're in, you're out the next day. This would have been a tiny loser. You're in, you're out the next day. That was a loser. You're in, you're out. That would have been a winner. We can keep going back here. This was a huge winner. If you guys remember, the low was December 24th, 2018 of last year. And you basically would, this system was saying there's extreme panic in the market. You would have bought it. And then the next day just had an insane rally. And SPXL, if you guys can see, was up 15% in a single day. So that's how these props can really add up in extremely horrific bear market conditions, even trading from the long side. Now let's go back into TradingView and look at my sizing, because I definitely want to talk about how I size this trade real quick with you guys. And so we're going to pull up the calculator again, and I see here my max size ended up being 31 shares at 46.32 cost. So let's calculate what that is. 31 shares at 46.32 cost is 143K. So I had $143,000 on this trade. And remember, this is a 3x levered fund, so that's essentially like putting in around 430K of a bet into this particular market. Now, I'm not risking all that 430K, right? And that's a huge key thing to understand. I'm not risking that 430K. The odds of the market opening up at zero the next day are almost zilch. Like, it essentially can't happen. And so what I'm doing with this particular trade is I'm going back in history and I'm developing a confidence interval that tells me, hey, if this thing really craps out, then I could lose around this much. And I sort of size from there. And it's a little bit tougher than the defined stop method. Unfortunately, you cannot do that in this trade because you're trading overnight. You can't execute these trades overnight. But let's go back to TradingView and I'll show you guys kind of what I looked at here. So let's see. Let's go back to one that was a huge gap down. You guys remember the Valpocalypse back in the beginning of 2018? We had this down close, and then there was a huge gap down, and then it kind of rallied back and actually finished as a good trade. But I use this as sort of a proxy for my sizing here. So let's take a look at this. And I said, on the worst of days, maybe I'm down 15% in the trade. Maybe we can add a little bit of air there and 20%. So 20% in SPXL, remember, is about 7% in SPY. And so I was looking at about a 7% max possible loss. And that would be a very, very bad loss. I don't really expect that to happen, but that's sort of my, I need to go and really start getting this size off because I'm going to have my account severely impaired if I don't. So anyway, let's go back to that calculator. Let's times it by 7%. So yeah, 30K was the absolute max loss and what I anticipated, and that's what I sized it off of. Now, that's not exact what's going to happen when there's a losing trade every single time, right? Like most of the time, a losing trade on here isn't 7%, it's 0.2%. They're 0.5%, but you always size with the max loss scenario in mind. And the other thing about this trade, and this is a very advanced thing to do, but if I ever were starting to reach this point where I was reaching my max loss overnight, I do have the ability to go in and hedge with ES futures, which are the S&P 500 futures overnight to hedge this position. Now, if you don't have futures access, you can't trade the overnight market, you can't hedge, so that's a little bit issue. I have that convenience, so that that gives me a little more peace of mind when I'm putting this type of trade on. But it isn't an easy trade. It's not like the vol trade where I get to put a hard stop in the middle of the day and say, hey, if this thing goes on it, I'm out. I have to sweat the overnight. But sweating that overnight is what gives me a lot of the edge. And so this type of trade, buying the fear, especially on huge down days and selling the next day, is pretty well documented. I'm not some genius that just figured it out. It's an edge that has been thoroughly ingrained in the market just because of the way market dynamics work, and people have to force sell at the close to cover margin calls and other sort of administrative things on these huge down days. And that's why this strategy worked. And I want to show you guys one more thing before we head out here. And this is the buying the Nikkei dip, and this was done by a brilliant author, options author, who actually AK talked about on one of his latest Real Vision videos. If you guys go back and watch that, he's an options expert, and he went in and just looked at buying the Nikkei, the Japanese indices, when it had a big crash. Very similar concept, and you can see just how solid this trade was since 1993 all the way until mostly present day. So it's across all markets. In general, it's a very solid trade, and why? Because we're taking advantage of the fear in the market. We're taking advantage of people puking out of their positions. And when people are selling in fear, that usually means they're not selling with a rational mind, which means that the price is overextended to the downside. And that's why this trade works. Ultimately, we're taking advantage of fear in the markets. All right, guys, that's it for this video. Thanks for watching. I hope you guys learned a little bit about this trade video. I'm having a lot of fun doing these recaps. I know you guys love them. I'm going to continue to do these throughout the rest of the month. Rest of the year. If we have another volatile month, I'm gonna have another fun time telling you about all these trades, and we'll see how they perform going forward. Nothing's ever guaranteed, but I'm pretty sure I'm gonna finish this year pretty hot. And please go down, hit that like button, hit that subscribe button. Let me know exactly what you want to hear besides these trade breakdowns. I'll be happy to do it with you. All right, guys, I'm heading out. Stay fallible.